Welcome to the True Wealth Project, where we talk business, real estate, and lifestyle on your way to building a wealthy life for generations to come. I'm your host, Sam Khairi, and I hope you enjoy the show. Hey, everybody, this is Sam Khairi, the host of the True Wealth Project. I'm super excited to have our guest here today. Sandhya has agreed to join us for what's going to be an amazing show. I just know it, knowing Sandhya for a little while now, and just knowing her story and background and what she's able to do in the commercial real estate. I'm super excited. Sandhya, thanks for agreeing to do this. Thanks for being on.
Thank you so much, Sam. It's such an honor to be here and add value to your guests.
Yeah, absolutely. So I'll do a quick intro of Sandhya and your background, and I know I'm not going to do it justice. So bear with me. I've got a few points that I want to go over, and I'm going to ask you, Sandhya, to kind of give us a brief intro of yourself as well. As I understand it, you're GP and LP on over 3,000 doors. Obviously you're a speaker at conferences and multiple events. You've been featured on many podcasts, and I think one of the most impressive ones is that you have over 25 years of investing experience, which is amazing to know. Most people, they kind of start later in their careers, but it's just impressive to see your track record. So if you could tell us a little bit about yourself and kind of how you got started and your journey as to how it got to where you're at today.
Sounds awesome. Thank you. I started out my life like most Asian geeks in a very math-focused engineering background. That's where I got my bachelor's and master's in electrical engineering and started working for a high-tech firm. Realized very quickly that marketing, sales, and management types are making all the decisions, and I wanted to understand how that works. So my company was kind enough to send me to school for a part-time MBA. And, when you're in a company, you automatically invest without realizing it in mutual funds with your 401k. But the MBA really showed me the other side of investing. So I joined investor clubs and started trading stocks pretty actively from that. And so once I had children, I was able to live off of just my stock market kind of income and returns and did not have to continue my W-2. So I quit for a few years, then went back again, and then finally quit because I was able to. And the other thing is I was looking then for something that would help me save on taxes. And I did not like single family rentals because I felt like I didn't want to deal with the whole tenants, toilets, trash, and termites, the 4Ts as we call them. And I did not have a background as a handy person growing up. I mean, spreadsheets are my thing. I love analysis, and I've lived in Dallas for 32 years. So I know the local market really well. So whenever I looked into real estate, single family didn't make sense for me. But I attended a weekend seminar, heard about multifamily, where you do asset management and you can employ a third-party property management company to do all the day-to-day work for you, maintenance, leases, etc. And that made sense because project management was also my background in my high-tech career. Yep. So that's how I got into multifamily. And so I went from 0 to 86 doors for my first general partnership deal back in 2019. And prior to that, I invested passively by rolling over my 401k money into an IRA with which I could invest passively and build relationships with general partners, get to know the ropes a little bit, if you will, like a passenger in a plane before I was ready to be the pilot. So that's where I am today. I'm a general partner in about 8 deals. 3 have gone a full cycle. And, I've been a limited partner in over 20 deals.
That's amazing. I mean, there's a lot there that I really want to explore, but I'm gonna just keep it to maybe just a couple, which I think is super important, right? So you mentioned, it's kind of starting in your general 401k, your some of the stuff that most of us get into as W-2 employees, right? What's amazing is that you were able to kind of convert that or be able to kind of live off of that, if you would, right? So I mean, obviously that it made sense for you at the time, right? One of the things that we do emphasize is some of the benefits that real estate offers, which we don't necessarily get from stocks and things like that. So that's really an important point, that you kind of saw that additional bonus or the added benefit of real estate that really helped, right? And you were able to take advantage of that. And the second, which I really want to kind of poke at a little bit, if you would, right, is investing passively, right? I mean,
Mhm.
that's how I started my multifamily investing career as well. And to me, it made sense just because you get
Mhm.
in as a limited partner. You're not necessarily doing all the work, right? Not knowing, which part of it you like, right? I mean, we got in and we got to see the ins and outs,
Mhm.
like you did, right? What were your experiences in getting into some of the first early on experiences as a limited partner? How did those go, right? I mean, it's we all have different experiences. I want to kind of poke at that a little bit just to see how your experience as an LP was just starting out.
Several of the deals I got in as an LP was in the 2019 timeframe, and many of them have already sold. We're right now in April 2023. So those
Yeah,
deals did really well because the cap rate compression really helped. So even if the sponsors weren't that great, the deals did well regardless. So I'm very happy that I invested passively first, understood the ropes, got used to the terminology, etc. Before I go to someone and raise capital, bring them in on an investment. You've got to really show your knowledge, demonstrate your, expertise, if you will. And so asset management is a very big piece of it. What happens after the deal closes? So you want to definitely be talking to the general partners as a passive investor who will be managing the asset after it closes. That's a very important piece that I tell people. Some of my lessons learned are there is a deal that didn't do well, but I'm somebody who monitors financials. So month to month, when the financials started not doing so well, back in 2020 when COVID hit, and the deals where I was a general partner, I was careful about the spending. But in this case, I was a limited partner, and they were spending too much money at that time when we didn't know what the occupancies and delinquency could result because of COVID. And they took a lot of chances that I didn't agree with. So I would nag them on a regular basis. And they
yeah,
were able to force and sell it in early 2021 to where we broke even and made a little money off of that. But if they had
right,
missed that window of opportunity and held on to that deal longer, we'd have probably lost money. So,
yeah,
even as a limited partner, definitely in this economy, especially monitor those monthly financials and make sure you at least check the basics, which is the net operating income has to be sufficient to support the mortgage payment. It's like your home. You have to make sure you make enough money to pay
that's
your
right.
mortgage, right? So same
Absolutely.
concept. So that would be the first warning sign, I would say, as a limited partner, something to check for. And if
That
that's not happening, it's called debt service coverage ratio. Your DSCR is less than 1. That means you don't make enough money to even pay your mortgage, let alone other capital expenses. That's the first sign of a deal in trouble. So you want to take action. You want to start communicating with general partners if that happens to you as a passive investor. And I was already doing that back when the economy wasn't so bad for real
right.
estate. So right now with the cap rates going up, there's a lot more deals in trouble because they can't sell it or refi it for the high leverage, especially the floating rate loan deals that many got back in 2021. Like bridge loans were the flavor of the day or flavor of the year in 2021
Absolutely.
and even early
Absolutely.
2022. And the challenge with that is now they're highly leveraged deals, and some of them don't have the net operating income to pay the mortgage.
Yeah, no, absolutely. I love the fact that you're able to kind of hone in on some of the financials and be able to pick out
Mm-hmm.
some early red flags, if you would, right? I
Mm-hmm.
mean, our episode that we're talking about today is about saving the deals, right? I mean,
Mm-hmm.
shooting or recording this today, we're early Q2 2023, and as you said, I mean, as you've seen in the past couple of days, at least, I mean, there's stuff in the news as to
Mm-hmm.
there's stuff going into foreclosure, and we're gonna.
Mm-hmm.
I think we're gonna continue to see that. I don't know how bad it's gonna get. I don't know if anyone's got a crystal ball that they can exactly predict what's gonna happen, but we're gonna continue to see some of these foreclosed deals or distressed deals, if you would, right,
Mm-hmm.
come about, and but to your point, if you're able to kind of detect some of those early signs, if you would, right,
Mm-hmm.
then you're probably in good shape. You can at
Mm-hmm.
least mitigate some of those risks and maybe put the property back on its wheels again. So, are there some of the other warning signs, if you would, right, that
Mm-hmm.
a deal is potentially distressed? I mean, we talked about a couple things. the DSCR and your net NOIs, are there things other things that you can kind of point to on a monthly basis, quarterly basis, to kind of give you a taste of, listen, this deal could be in trouble, right?
Yeah. I think the first sign is if your communications from the general partners diminish. You used to get monthly reports. Now maybe you're getting quarterly reports, or there's radio silence. That's always a sign. What are they hiding? Why are they hiding from me? If I don't hear from them often enough, then I start to wonder, so I'll reach out. So make sure you're at least once a month getting some sort of communication where you can see the financials of the deal. That's always a sign.
Huge.
The next sign is when you have a few months where your net operating income is not enough to pay the mortgage, the next thing that a lender, a bridge lender or a floating rate loan lender is going to do is they're going to take control of that operating account. They're going to put it in some kind of a cash management system, lockbox kind of thing, where they take control of it. And so the lender is going to tell the general partners what they can spend money on and what they cannot. So everything is now tightly controlled.
That's right.
Rather than, okay, GP, just go take your money, do your thing, come back with the results. No, we are going to control it. Okay, that's a sign. The next thing I would say a limited partner can ask for if all of this is happening, right? What's a basic question you can ask? You can look at your financials and say, is the NOI high enough? The next one you say is, are we in some kind of a cash management system where the lender is controlling our spending? The next sign is, what are your aging payables looking like? Are you net 30 or are there 90 plus days of invoices still waiting to be paid?
That's
and
huge.
How much is that amounting to? What is your total net cash in the operating account and in any other capital account? How much is left of lender draws, and is the lender still willing to loan you money so you can go improve your interiors, etc.? After all of this happens, when you're not paying invoices and all these contractors are after you, well, the next one that happens typically is the GP starts to loan money into a deal. So you can ask them, did that happen? So once that happens, the general partners are putting money into the deal and it's still sinking, right? You haven't quite plugged this hole in the ship, and so water is coming in.
That's
the
right.
hole is getting bigger. So then what happens? The next step, that's when the capital call happens. That's where you, the limited partner, instead of getting distributions, is instead asked, hey, I need more money to keep this deal afloat. I don't have enough money, right? So they're asking you for an additional loan or a capital call, right? What happens after that? Sometimes if the loan is having a rate cap or doesn't have a rate cap at all. So what the heck is a rate cap? Well, interest rates have gone up, right, in 2022. Rather than being the 3 or 4% we were hoping for in 2021, the Fed has kept increasing those interest rates. So some deals may have to pay double the mortgage payment, the interest, compared to what they had initially underwritten for. So in some cases, like my deals, I do have floating rate deals, but we purchase what's called a rate cap. That means by 5.25% is one of my rate caps. So that's the maximum interest I will pay, even if the Fed keeps bumping up the interest rates to 7 and 8%, etc. Like that spread keeps going up, SOFR plus spread. So is that happening here? So then your lender might ask you to buy an interest rate cap today. So in 2021, I bought an interest rate cap for a deal that was only $40,000. Today, that's going to cost me about $500,000, right? So it's a huge jump, and that's only a 150-door property. So now think of the mega deals, right? 500, 600-door properties costing, $70, $80, $90 million. Well, the rate cap to buy one of those could be millions of dollars, and your lender might require you to buy one right now. Well, the GPs don't have money to buy that. They may come to you for a bigger capital call, and you would be in default. That's the next step. And what happens after that? So these are all the warning steps, right? Starting with the DSCR, cash management, not paying invoices, GP is loaning money to the deal, capital call, requiring additional escrow for a rate cap purchase, etc. Now you're in default and you get that notice, and then it leads to the foreclosure. So there's several warning signs before you get to foreclosure. The problem with a foreclosure is that the LPs lose all of their principal. Versus, let's say today the deal is struggling, and so if you tried to sell it, the broker comes back and says, oh, you bought it for 25 million. Well, today I can only get you 22 million for it. So you're going to lose 3 million.
Yep.
Well, maybe that amounts to a 10 or 20% loss of principal for the LPs. Once you pay off the loan, pay off any other outstanding debt, maybe you can only pay back 80% of the LP capital. That's still better than a foreclosure where it's 100% of LP capital. Because once you do a capital call, you have to pay that back first.
That's right.
And so really, unless you see a very clear path in 6 to 12 months of getting out of it, why go to that stage? Sometimes it might be better to fold, as we say in cards, right? You might need to fold rather than stick around hoping for a better tomorrow, because it may be 2025 before the interest rates come to a level where this property will even break even. So really be, truly realistic about that analysis. Speak to your lender and speak to your listing broker. Those are the two people to whom you can have as an LP tell the GPs to send it and say, okay, get a BOV, a broker opinion of value. How much can you sell it for today and how much of a loss it is? That's number one. Next, if you had to refi now, how much can you even refi enough to pay back the original loan?
Right. Yeah, that's
and
right.
So if not, you might be better just selling it off now, even if it means a 10 to 20% loss, than incurring additional debt from capital calls or other loans and ending up in a foreclosure situation.
Yeah, no, absolutely. I think you just a lot here to kind of just a lot of great information and just kind of the sequence of events, right? I mean, as you mentioned, it's the warning signs come first, right? And then before the shit is completely sunk, right? But there are things that you can do, right? I mean, these are great questions that you should be asking, whether you're GP, LP, and anyone involved in the deal. And I agree. I mean, just hoping for a better tomorrow is not necessarily the solution, right? I mean, you could have some predictions, but I don't think any one of us has an idea of what we're going to be up against here in the next few months. We could potentially predict, right? But at some point, you might be, to your point, might be better off kind of minimizing your losses and just kind of move on and potentially do better on next deals, because as we know, investments are exactly that, right? I mean, not every single investment is going to go well, and conditions change. We work with the best information we have at the time, and you got to make the decisions, make the call, and move forward. So that's really cool. I think just kind of pivoting a little bit, right? I mean, we talked about some of the warning signs, right? I mean, what I'm going to kind of combine the two, if you would, a little bit, right? As GPs, LPs, what are we talked about asking the questions, right? What are some things that we could do to avoid those capital calls? Because we talked about the series of events, right? I mean, capital call, in my opinion, is one of the last resorts, if you would, to try to keep the deal afloat. What can we do to kind of avoid getting to that stage? Because at that point, it could potentially be late, right?
Yeah. So the first sign is when you don't get a distribution, right? Why are they not making a distribution? Okay, because the mortgage payment went up. Agreed. What about the net operating income itself? Are your collections, which is your top line revenue, how much rent and other income I'm collecting, minus your operating expenses? The difference between those two is the net operating income. How does that compare today compared to initial projections, let's say from 2021 or 2022? So if you're able to keep your revenue really high and your NOI high, that means your property is performing well. Yep. We unfortunately got hit with a mortgage, and that's why instead of having that 30, 40K available every month to make a distribution, we're having to just send it back as interest to the bank. So the bank is getting richer. That's why I can't pay back the LPs. In other words, the general partners have control and all of their controllable expenses and revenue, right? Which is total revenue, operating expenses, NOI, net operating income. Those three are doing well. So they've done well with their controllables. And so what they're not doing well is their uncontrollables. So maybe taxes went up, maybe insurance went up, and mortgage went up. But taxes and insurance both also hit your net operating income.
Yep.
So that's the first question I'm going to ask is, how well are you doing in your things that are within your control? And the financials will give me that. If I get monthly financials on my deals as LP or GP, that's going to tell me how we're doing. That's your first sign. If my revenue and NOI is not keeping up, well, then I'm going to, this is a losing battle, right? The cheetah is coming too fast at me, and as a deer, I'm not able to outrun the cheetah. It's going to
Yeah,
get me,
that's
right? That's pretty much the
really good
analogy I would
analogy.
use, right?
That's
So
right.
look at that reasonably, be realistic about that. When am I going to run out of money? So I look at the net cash positions. I look at how much off my NOI is from the mortgage, right? So if you don't have a net operating income enough to cover the mortgage, what is that difference? Is it only $10,000 a month? Is it $20,000 a month? How far is that gap? So can I catch up to that gap by finding a way to increase my revenue or other income? That's the conversation to have with property management is right now my mortgage is 100,000. Our NOI net operating income is only 90,000. I have a gap of 10K. How soon do you think we can cover that gap? Because if I can't cover that gap, my debt service coverage ratio is less than 1, which means I need to go back and read my loan agreement to understand when my lender is going to take control of the deal.
Yep.
Because DSCR is one of the conditions.
That's
For
right.
how long will they let me write it without the proper DSCR?
No, that's right.
And that's a very important question to ask. So if you want to avoid a capital call, which you're saying is a bad thing, which I agree is a bad thing, then look at this NOI, look at your DSCR, ask what the aging payables are. Have you been paying your bills in a timely manner? Do you have bills more than 90 days old? And if all of those three are not in a favorable response, and we don't really think in 3 to 6 months from today we can turn this property to cover that gap, you might talk to a broker about selling it. There are a lot of people waiting in the sidelines for bargain deals, and so you know what your threshold is to break even. So do a break even analysis. At this price, if I sell this property, I can get all my LPs to be whole, and figure out that number.
Absolutely.
And give that number as your, target to the broker. Same way with a refi, right? So talk to your lender broker and say, I need this much in proceeds to refi and still have some money left to pay maybe a small portion of my investor's capital or have something available for capital expenses. So have those two numbers on a monthly basis, send your financials and have those two numbers in front of your lender broker and listing broker.
That's great. One of the things that we talk about is the controllables, right? I mean, you mentioned controllables. It's a lot of folks kind of rely on the what happened to me as opposed to there's still a lot within a deal you can control, right? I mean, yes, the market has turned, and in specific markets, even rents have maybe plateaued or have started to decline. So some of the things that, we may not be able to control, but there's a lot that we can control, right? I mean, there are strategies we could implement to kind of control our NOI, or whether it's our revenue, expenses. It's not always, it doesn't always happen to us. And being in this profession, I feel like it's our responsibility as GPs to kind of look ahead and be able to have a plan in place. To your point, it's, multiple steps. And not only to be able to get out of it, but to do well. But if that's not the case, we got to be able to make that call and kind of move on. And that's really huge, right?
Yeah.
So anything else on that? I do want to pivot a little bit because I know kind of your background, if you would. I know you mentioned you live in Dallas, right? And how important has it been, or do you continue to practice this where you kind of, a lot of the deals that you focus on are, I mean, a lot of people that I know, we all love Texas. Obviously, Dallas is one of the great markets, right? Is your focus kind of mainly on Dallas? And if it is, I mean, why is that important to you?
I've lived here 32 years, so I know every little submarket. I know streets. If you give me an address of a property, I can immediately tell you if I'm even slightly interested in pursuing that deal. So it saves me a lot of time. My deal screening is so quick. I have my little pockets. I have my little boxes. So even brokers know that. So I'm interested in certain neighborhoods. I'm interested in certain price per door. And I know what class of property I like. So all of those things just speed up the process. And so I'm your local expert. My other huge competitive advantage is I do a lot of Facebook Lives from my properties. So all my current active properties where I'm the asset manager are within a 30-minute drive of my house. So I could even be just running an errand and drive past one of my properties. So it's very easy and convenient for me to check on my properties. So I don't bother my on-site on the first week of the month or the last few days of the month. But the rest of the time, I can definitely drive by and check anything I want on the exteriors. And even on a busy day, I can just say, give me a key to a vacant unit and go inspect and walk in a vacant unit before someone moves in, just to make sure, it's a little QC check on my part. Yeah. And so that's a huge competitive advantage. And as long as the market does well and it performs well in all these locations like Irving, Carrollton, Garland, these are examples of great suburbs in which our deals have done well. So why bother go anywhere else? I don't go as far as Houston because it's a 4.5-hour drive. So I can't plan things ahead of time. And Houston, as an example of another Texas market, is that every little block, 1 to 2 blocks, the scenery changes. So you could have $1 million homes round the corner from a drug-infested apartment with a lot of crime issues. Right. So it's very, you need to be very, very local in Houston to be successful there. So I haven't attempted it because I don't want to have to plan each time I go and check on my properties. If I just think about it now, in 30 minutes, I could be at another property, and I like that convenience. Yeah. So until the market fails, I don't see a need to go elsewhere.
Yeah, absolutely. I mean, I've one of the criteria that I kind of look at is, whether we have someone relatively close that either lives there or has other properties there, has experience in those markets that can do exactly that. But I think from your vantage point, it's a huge benefit and one that you've kind of leveraged to be able to get to where you are, and I think it's amazing. Just having that local knowledge, you're able to not only see live how the properties are doing, and you're able to kind of have like hands-on experience with the property managers and whoever else is that's on site, which is amazing. That's really cool.
There's a lot of little nuances people don't realize, but even in terms of the counties, like Tarrant County versus Johnson County versus Denton County, there's such a big difference in taxes. There's a difference in your eviction courts and what are your, little blue pockets versus the more landlord-friendly pockets. There's the cities and their laws and their requirements, dealing with city inspectors. There's so many little nuances to asset management. The type of unit mix that you would support if you're in a certain location versus another, more of family-friendly by a school with 2 bedrooms versus the studios and 1 bedrooms. Again, there's so many details when it comes to underwriting and finding the right deal, because a well-begun makes it so much easier for you to have that nice runway on a deal, especially when you hit problems like this past year with these rising interest rates, right? And increasing mortgage payments on floating rate deals. So I think you want to have all the possible, tailwinds going into a deal. And one of them is local market knowledge.
Yeah, and I think you kind of touched on it, but in my mind, we got away a little bit from, managing an asset, if you would, in the last couple of years, just because I think you had some experience on the positive side where your deal did well because of how the market appreciated. But yeah, I think just being able to manage an asset really well and having that knowledge and experience is going to be key. And to me, that's true realistic investing experience that not many possess, and luckily you've got that, and you offer that to your investors as well, which is huge.
Yeah, if I could add just one thing, if I talked about, I have over 26 deals now, of which several have completed a full cycle from a passive investing side. Yes. And if I pick my 5 worst passive deals to date, all of them have one thing in common. No general partner is local to the area.
That's amazing.
It could be somebody in Dallas investing in Houston. It could be somebody, in a location at least 3 to 4 hours away, if not a longer distance. And that's a very common trend among all my passive deals that did poorly.
That's an amazing stat. I bet that number holds true across the entire industry. I just have a feeling that's probably a good stat to follow. But anyway, Sandhya, I really appreciate your time. I want to respect your time and availability. So one last question. How can my listeners get a hold of you?
Just like you did in LinkedIn. That's the platform where I post a lot. But my website is engineered-capital.com. And if they visit my website, they can download a free checklist to vet a sponsorship team. As a passive investor, what questions you should be asking before you wire your hard-earned money to a sponsorship team.
That's amazing. You know what? I think I'm going to go and download that right now. So
Mm-hmm.
before I forget, again, Sandhya, I really appreciate it. This was awesome.
Thank you so much.
We'll be talking soon, I'm sure, offline.
Sounds great.
All right. Thank you. Thanks for watching today's episode of the True Wealth Project. And I hope you enjoyed today's guest as well. If you want to catch more of these episodes, be sure to like and subscribe us on YouTube, as well as other podcast platforms. You can also get in touch with me by following me on Instagram at @officialsamkhairi, or you can send me an email at sam@aftocapital.com. That's sam@aftocapital.com. See you soon.